Hello, I'm Kevin McCaffrey, and I thank you for joining us for the Private Markets Insider webinar agenda I'm sharing on the screen. And let's kick off with a few quick program notes. We have two panels today with investors and other insiders discussing long-haul effects on private markets. One panel on changes and opportunities in private equity, and the other from a private credit perspective to begin in about 45 minutes. Also, please note that the following presentation is for informational purposes only. None of the information shared or the opinions given are to be construed as an offer to buy or sell a security. If you have any questions for the speakers during the program, I encourage you use the Q&A feature, and we'll answer as many questions as we can during this webinar, and we'll follow up afterward to answer any remaining questions and to have conversations where appropriate. That's the point here, is for us to find appropriate contacts, build conversations, relationships. That's what this business is about. So these and more details, including speaker biographies, we won't be able to get into all the amazing things they've done as we make introductions. So you can review those on the website at privatemarketsinsider.com. Now, I'll take down this agenda. Hello, everyone. I'm Kevin McCaffrey with Private Markets Insider, and I thank you for joining our webinar. It's hard to believe it's already November here. I wish all of you an early and happy Thanksgiving. The theme today is long haul effects on private markets, and I recognize that the term long haul is a bit loaded and associated with COVID, so we will address that, but not only that, because there are other things to talk about, thankfully. Many of the effects we're dealing with, high asset prices, low interest rates, due diligence processes, never-ending Zoom calls, they've all been exacerbated by COVID for sure. But everything does not need to be seen through that COVID lens. Of course, I recognize we're still fighting the pandemic, so I don't want to be dismissive, but it's not the only thing to talk about. At least we can all be thankful for that. And along with countless other things, one thing I'm thankful for in particular is that inefficient markets and the opaque nature of private markets in general keeps us coming together for these conversations. Most of you are aware efficient market theory relies on transparency and access to public market information for accurate pricing. So my inefficient market theory makes it necessary that we provide access to private markets insiders in order to get things done. Through my events and direct introductions to investors, fund managers, and other key players, we help people make decisions. And I'm thankful that so many of you feel the need to keep feeding a private markets community of people we can trust, people with actual skin in the game and insights they're willing to share. I wonder what else we can be thankful for. So as we approach Thanksgiving, I'm reminded that this holiday represents the best of who we are, making the best out of bad circumstances and simply showing gratitude. So with that, I'd like to bring up our first panel of speakers and introduce our moderator, Cheryl Schwartz. Sheryl is Chief Investment Officer of ALTI and Adjunct Professor of Private Equity and Finance at Fordham Gabelli School of Business. She's been Managing Director at Caspian Private Equity, now Flexstone, Perseus, and TIAA CREF, leading investments in private equity on behalf of institutional investors. In these roles, she built diversified portfolios with a focus on ESG, emerging managers, and North American mid-market. Sheryl built and led TIAA CREF's alternative investment team, which included a diversified portfolio of $13 billion of investments in private equity funds, co-investments, mezzanine debt, and timber. Ms. Schwartz also serves on the board of directors of Women's Association of Venture and Equity. And as I pass the microphone to Sheryl to moderate this first panel, I'd like to ask Sheryl, help me fill in any gaps around your role at ALTI and how retail investors are gaining greater access to institutional quality private equity opportunities. And while you're at it, if that's not a mouthful, please share something in your life, personal or professional, for which you are thankful.
Okay, thank you, Kevin. And thank you for the opportunity to be here with everyone today. I'm not going to get into ALTI right now because we have a big panel, but basically we're creating an interval fund to focus on the private equity markets, and happy to explain more at a different point in time. What I'm thankful for is that I have not gotten COVID, and that they've created a vaccine in a record amount of time. And I'm positive and confident that other good things will come from the research and development that they've done on the vaccine, and will help all other diseases. Just the research and knowledge, I think, will lead to a lot of good things. So today we have a great panel that composes GPs and LPs. And just by way of background, just thinking about COVID and its impact on the asset class overall, it really highlighted the durability of the private equity model. When it first struck, most people kind of went into panic mode. No one was ready for it, but the GPs and LPs quickly established strategies and plans for how to deal with things. They prioritized cash flows, they drew down revolvers. Deal flow kind of came to a halt, but all of that only lasted about 1 quarter. By the second quarter, people were starting to dabble into pipes and distressed debt. And then really by the end of the year, everything had not only resumed, but has been going gangbusters since. When you look at the Burgess data, they showed the first quarter private equity was down about 9%, versus public markets were down 20%. And then by the end of the year, total for 2020, private markets were up about 22% and public markets were up about 16%. So overall, partially due to help of the Fed, but I think the lessons from COVID are that private equity is a very durable model and can survive downturns. So now we're going to introduce everyone first, and then we'll get into questions. Does each person want to, Whit, do you want to introduce yourself and tell us what you're thankful for?
Sure. Thanks, Sheryl, and thanks, Kevin, for pulling this all together. Thrilled to be here. So Whit Matthews, I'm a senior investment director with Aberdeen. Aberdeen is a global asset management firm headquartered out of the UK, investing in most asset classes and geographies that you can think of. I'm a senior member of the U.S. private equity business. We're all based in Boston. Really a niche kind of boutique strategy that sits on that bigger Aberdeen platform. We've been investing in the U.S. lower middle market and kind of small cap universe for about 2 decades now. We primarily raise commingled funds every 2 to 3 years, and our investment strategy is really a kind of go anywhere small cap strategy. So we invest in funds, we invest in co-investments, secondaries. We'll do indirect deals with the independent sponsor universe. So really a flexible mandate and secondary, a flexible mandate to kind of go anywhere in terms of kind of best opportunities, but really all things kind of small cap and lower middle market oriented. Something I'm thankful for, I guess I'll keep it lighthearted because I like to wear my heart on my sleeve and kind of share some personal insights all the time for folks who know me. We had a little bit of a microburst up here, or storm last week, and we lost a bunch of trees. None of those trees hit the house, which was great. None of the trees hit any friends' houses, which was awesome. It did crush my 8-year-old daughter's swing set, and it did crush my 11-year-old son's sport court. But all those things can be fixed, and everybody is happy and healthy. And so that is something I'm thankful for in the last week.
Thank you. And Jeff?
Okay, there we go. So I'm the CEO of what is actually not Moreland Management Company anymore. It's Moreland Wealth Services Corporation and Agate Fund Management, which are two basically internally controlled entities for our single family office, which is headquartered north of Boston in the minor metropolis of Beverly Farms. What you see behind me is actually what's there if I turned around. And we've been a family office, a family investment office after the sale of operating businesses in 1986 and 87, when several were created out of the same family group. I was almost all the time effectively chief investment officer without the title. I only allow one title at a time here. So it was CEO for the moment, a job I actually don't like very much. Our basic investing philosophy I set pretty early in the first decade, and it was to be an all equity portfolio because one, we were taxable, and the tax treatment of capital gains and dividends, qualified dividends, is significantly less. We would be very long-term investor, even sort of a rolling 75-year time horizon, even if the investments themselves were much shorter. We would be hyper diversified across many factors. And the asset allocation program, such that it is partially described in an article that I published in Journal of Wealth Management in 2000, in the year 2000. It's in the spring issue called Asset Allocation and Asset Classification. The basic idea is we don't have targets, we have risk limits. So it's simultaneously a bottom-up approach, and that's based on a general idea. Sheryl knows my more flamboyant way to describe this, but basically I see investing as requiring both wanting to do it and the opportunity to do it. You need both together. So our approach to selecting funds or managers of any kind is really a bottom-up approach subject to the risk limits, and the risk limits cross many factors. And again, this is a little bit better described in the article, at least in part. In a normal year, well, there is no normal year. If a normal year is atypical. So our pace of investing, if you include co-investments and funds, is about 15 to 25 things a year. 2019 and 2020 were anomalies for different reasons. Obviously, 2020 was COVID. 2019 had to do with an internal restructuring that we did. Part of my job is still investing, actually a large part of it. The other part is handling the rather creative versions we have of trust and estates planning and the taxation. I'm the co-author of the CFA monograph on taxable investment management. And of things that I am particularly thankful for, it was a challenge to think of something sort of serious. And suddenly it came to me, was actually going to Shaker Heights Public High School. And at the time, for quite a time actually, for almost 4 decades, Shaker Heights was a small community east of Cleveland. It had the highest per capita income in America, or at least one of the highest, not because of billionaires, but because so much of the population were professionals, doctors, lawyers, engineers, executives, et cetera, all clustered, but they also were highly educated in most of the households, which meant the public school system had basically an unlimited budget and unlimited, sometimes overflow parental interest. So the quality of the high school was such that we had nearly 100% matriculation to 4-year colleges. A grossly disproportionate number went to Ivy League schools. And its other claim to fame, which is the subject of 2 or 3 documentaries, is that Shaker Heights was the first affirmatively integrated community in America. There were committees formed to make sure that Black families were not discriminated against for housing, that there was no redlining for house purchases or mortgages, and that they were brought into the social fabric of the community. This, as an irony, was going on in the late 60s, almost simultaneously with massive race riots in downtown Cleveland.
Very interesting. A lot of political things in that. So we'll stick to private equity. Jake, if you could introduce yourself and give something that you're thankful for.
Yes, thanks, Cheryl. I'm Jake Fisher. I'm a principal at Delta V Capital. It's a technology-focused growth equity firm based out of Boulder, Colorado, and Dallas, Texas. I used to work, prior to Delta V, I worked at a firm called Co2 Management for about 5 years. And part of that, I spent about 5 years on the sell side covering large cap public tech equities. I am a newly minted father to a fantastic little girl, so I am certainly thankful for her. And I'll leave it there. Thanks, Cheryl.
Sure, thank you. All right, first question will be for Whit, but certainly it would be great or if Jeff or Jake chimed in as well. Given that you focus on the mid-market for secondaries and funds and co-investments, how has this sector performed differently than the larger end due to the impact of COVID? And how is this impacting your strategy going forward?
Yeah, I think there's a couple things to unpack in there. And so to be clear, I'd say we're even below kind of the mid cap universe. We really do think about where we're investing as kind of small cap land or lower middle market land. And that means different things to different people. But think kind of EBITDA positive businesses, kind of sub 10 million of EBITDA, typically enterprise values in that kind of sub 150 range, tends to be our sweet spot. I think at the outset, Cheryl, you used kind of the term durability of the private equity model has really kind of proven itself out throughout kind of this COVID transition that we lived in. I think that's true. And I think from our perspective, probably one of the dynamics that we see kind of most apparent is just the need or desire for entrepreneurs and founder owners of businesses looking for a partner, kind of having lived through kind of all the stresses of what was certainly the very beginning of COVID, right? When everything locked down and people weren't going outside. And if you owned a four-wall business, right, you were just shut. And there was a 6 to 8 week period there where entrepreneurs and founders just didn't know what was going to happen to their businesses. And so I think, having come out on the other side of that, and most businesses have bounced back, certainly not all, most businesses have bounced back, but for those, entrepreneur owners who have kind of gotten to the other side of it safely, if you will, I think the desire to kind of bring in a partner is probably more apparent than it ever has been, right? Having just another set of hands around the table. Some of that is just the professionalization and the resources that private equity can bring to bear. I think the other dynamic is certainly if you're a founder owner, like taking some dollars off the table and de-risking your exposure to your family asset is another component of that. So I think we've seen the kind of speed and desire for founder owners who have kind of survived this, that may have said they had a 10-year time horizon before, maybe to shorten that to kind of a 3 to 5 year horizon. We've seen that dynamic play out. Maybe embedded in there, there's the implication of tax changes that I think is brought some other people to the table as well, trying to get things done between now and year end. It's certainly going to be a busy kind of 7 to 8 weeks here, and we'll kind of see what ultimately transacts in terms of what's for sale now. And I guess the last thing I touch on as it pertains to maybe small cap universe versus large cap universe, private equity just in general has raised a meaningful amount of assets over the last kind of 5 to 7 years. And 2021 has been, if it wasn't a record year, it was one of the record years in recent memory. And so by certain accounts, kind of dry powder that's sitting out there in the private equity kind of buyout ecosystem in the US is north of $500 billion today. If you go back to 2014, that number was kind of 240, 250, depending on what you look at. And the vast majority of that capital has been raised by kind of mid and large cap private equity. So think kind of funds north of $1 billion. And so if you think about that 2014 number, the dollars chasing kind of small cap universe were about 25% of what was that dry powder number today. Back in 2014. If you look at that number today, of that 534 billion of dry powder that's sitting out there, you've only got kind of 10 to 15% of funds by just fund size chasing that small cap universe. And so, we continue to think that there are pockets of inefficiency, in small cap land. And on a dollar for dollar basis, small cap and lower middle market is a nice place to play. So I'll pause there.
Right. A lot of things we could follow up on that, but Jake, maybe you could talk about the impact COVID had on your portfolio, your strategy, and in particular, because you focus on technology, there's very high valuations in that sector. So how you attack that?
Yeah, and just to segue from what Whit said, I mean, we're sort of lower middle market focused. We keep our funds sort of small, between that $100 to $300 million range. So we actually fared from a portfolio standpoint pretty well during COVID. So later stage technology companies outside of Silicon Valley, lower middle market, fully formed teams, that's sort of where we focus. And one of the core underwriting pillars that we abide by is capital efficiency, right? Is the business break even? Is it profitable today? Or at the very least, does it have enough cash on the balance sheet to get there within 12 months of making the investment? And so that discipline around capital efficiency certainly helped us throughout COVID. I think we had 30 plus live investments at the time. One of them needed to go out and access the capital markets during that time. It's also worth mentioning that from a sourcing perspective, we focus on 6 specific sectors within tech that stem from the operational backgrounds of the investment teams. And none of these were disproportionately exposed or impacted negatively by COVID. In fact, we actually saw tailwinds, a number of them, like digital infrastructure and cybersecurity. They saw tailwinds as more stuff went online or went digital. And then last but not least, and sort of Whit alluded to this, but from a capital deployment perspective, we were actually quite opportunistic during COVID. So besides being sector focused and predominantly outside of Silicon Valley, we source about 2/3 of our investments via secondary direct purchases. So buying shares from individuals that are existing shareholders of companies. So still a very top-down thematic research-driven process with an institutional team that's developing relationships with management teams. But instead of only going to the management teams to write a Series D, C, D, E, or Z check, we're able to sort of work with these management teams a bit more flexibly. And so that means we can still write the Series C, D, or E check, but we're also able to help with things like secondary liquidity across their cap table. And these liquidity.
No, I'm just curious, did you actually do a lot of deals in the?
Yeah, and so we actually were able to put $100 million to work, and that's a lot for us. I mean, you go to a sort of a Tiger or two, that's a Monday. But for us, $100 million over 2020 was a lot, opportunistically across the fund and through co-investments. And so like we help these companies deal with smaller liquidity needs from founders that have since left the business, angel investors, seed investors, ex-management. And you can imagine, Sheryl, to your point, that during COVID, when the public market sort of ran off for an interim period of time, these individuals were now looking at this sort of illiquid position they held from 8, 9, 10 years ago that they were maybe going to wait a few months to think about, or a year or whatever. But now all of a sudden they needed liquidity now. So the liquidity need across the market went up, it amplified. And so we were in a really strong position to transact because we didn't necessarily have to wait or hope that a financing happened or whatever. Instead, we were able to actually work with these management teams we'd been developing relationships with and put $100 million into the ground at, with companies that we'd been tracking in sectors that we knew well at, what we think were pretty prudent prices. And that, to your point, has sort of helped us navigate this valuation environment. I mean, Whit hit the nail on the head with, you've got so many big managers now. And as everybody knows on the call, it used to be something that they'd scrutinize long-short hedge funds for. But as you grow in AUM or grow in fund size, right, your investable universe actually shrinks. So now you have more big managers that are actually going after sort of a fairly static supply of appropriately sized companies. It's like Boulder real estate, if you ask me. But that has sort of created this inertia in the sort of the mid to higher market, but we're still able to sort of transact and pick up those inefficiencies down in this, lower middle market where we're a little bit higher than Whit. We're like $150 to $400 million of enterprise value at entry, but that's sort of, how we thought about that.
That's interesting. And Jeff, you're investing your own family office capital, no investment committee, I assume, to to have to present to all the time like I've always had. Just curious, how do you determine your program for the year, what you're going to invest in and for the next few years, and how has that changed, or did it change during COVID? But has it changed your allocation? I know when we were talking, you told me you were approximately 50% public equity, 50% private equity, which, without significant liquidity or bonds. And so I'm curious, given, where we are in the cycle and how high valuations are and all the 500 million concerns that everyone has between geopolitical issues and interest rates and inflation, how you determine your program for the next 12 months and
Well, the short answer is we don't. That it to me is sort of a fool's game for us. We have a long time horizon, and the program itself is structured for the unknowability of the future. And what we have minimal cash. We structural cash of about 3% of the whole portfolio, but of course we have enormous liquidity in the public market holdings. The program at its core also sort of adopts Mies van der Rohe's famous quote, "Less is more." And there's in the general activity level, particularly in the public stock market active management universe, but also in private equity, there's an awful lot of motion with very little movement. And these things are long-lived. So the decision you make as an LP, you make today, you'll know ultimately how it turned out in about 10 to 15 years, depending on what you're investing in. So reacting to very short-term things, and COVID, in fact, in the grand scope of things, is a short-term thing. Our first private equity investment was in 1989. And I hate to call it, it's not an evolution, it's simply a development in the private markets. And it has certain trends, though, one of which is that past performance based on the most recent and yet stale academic literature is very clearly luck dominates skill, and past performance does not predict future performance. That's been the secular trend for the last 20 years, basically since the tech bubble. And the other is that in terms of the number of funds, the dollars by themselves don't necessarily matter because it's fundamentally still a type of supply and demand. So as long as the demand 5 years later is equal or greater to the demand relative to the supply when you started the investment, you should be okay, but there's no guarantee of that. What has happened is that capital is now global. It's not only global, but it is vast. And it shifts from asset class to asset class. And it will be shifting even more and more from fixed income, I'm afraid, into equity type instruments, because the asymmetry of change of interest rates generally, which the Fed does not actually control, up and down. So we try to stay pretty much fully invested in some form or another and sufficiently diversified so that we can be wrong an awful lot of the time. And it works at the portfolio level in part because of what's sometimes called Jensen's inequality. Jensen was a Danish mathematician who worked on convex and concave curves. This is a fraction of a fraction of what that meant. But in the investment field, it means that if you lose 20%, you have to make 25% to break even. If you lose 50%, you have to make 100%. If you lose 100%, it becomes asymptotic with infinity for the makeup. And so we try to construct the portfolio so that at the portfolio level, the losses are manageable, knowing that we will have a lot of Brownian motion in the results of the companies within the funds or the individual stocks in our passive but not index custom portfolios. So that's really how we do it. So COVID, the main effect we had with COVID was simply not having in-person meetings, and my serious reluctance to invest with new managers we did not already know pretty well, without being able to meet them in person, because there's a lot of information you get by having an in-person meeting that you will not possibly get on a Zoom meeting. No matter how much you've read of their materials, no matter how much number crunching it is, the body language, how they respond to unexpected questions, how 2 or 3 of them in the same room deal with one another in answering things, gives you a lot of information. Another quote, which I think was T.S. Eliot's Nobel Prize acceptance speech, is something on the order of, where is all the knowledge that is lost in information, and where is all the wisdom that's lost in knowledge? I think that's kind of a useful idea, along with the variance of what is attributed with no proof that H.L. Mencken said, for every complicated problem, there's a simple answer and it's wrong.
Well, so in other words, no change.
Not really. I'd say it slowed us up a lot because of the lack of real due diligence. I don't care so much about the number crunching. I care a lot about who I'm dealing with. You're with them for a long time. And some of the people who are very good investors, I wouldn't take my wallet into the same room. And other people, I would just leave my wallet and come back in a month and they'd have it all sorted.
I thought it was interesting when you mentioned to me that you have a credit line set up so that if you never have liquidity issues, because you could always just draw on that if you needed. So that's great that you were able to, set that up and have that.
Its normal level is essentially 0,
Right.
but it's there as a reserve LOC. There's plenty of leverage in the underlying investments. And of course, now I presume everybody knows that the increasing use of warehouse loans, IRR was a pathetically bad metric to begin with. It is now worse,
Right.
if that were possible, but it's totally useless now.
Right. So I wanted to, Whit, I know you do a lot of secondaries and you're involved in the continuation fund secondary market. And I'm curious, how do you make a determination on a continuation fund opportunity? And do you view them as secondaries or, primaries or co-investments? I mean, how do you classify them? The lines are kind of blurred on those. And how do you make a decision? I mean, there are so many of them happening right now. How do you prioritize your time to figure out, what the right decision is?
Yeah, no, it's a great question, and certainly this continuation kind of phenom is alive and well right now, and I think we've probably seen almost every GP at least start to talk about it, right, and think about it. And I think most of the larger institutional guys have either thought about or are coming to market or have come to market with some type of continuation vehicle. Sheryl, I think you're right? All of these situations are bespoke and they all look very, very different, right? And so to your question specifically, right, how do we think about them? There's a couple buckets, but I'd say they fall into 2 core buckets. You've got single asset continuation situations, which to us look a lot like a co-investment, right? You're underwriting a single asset, you're doing that single asset diligence, and your risk lies with that single asset. And so I think in that situation, we're quick to put on our co-invest hats, and that's how we think about it, right? Is this a good deal? Is this a deal that we want to own for the next 5 years? Who's the GP? And what are the dynamics of the continuation opportunity itself? And what do I mean by that? Really, what is the economic situation of the GP that's kind of rolling into this new transaction? And I think that can take a lot of different shapes. And I think from our perspective, probably nothing surprising to anybody on the panel or the call. But we're really looking for a very strong alignment of interest in that GP role, i.e., in most situations, we want to see the GP not taking meaningful capital off the table in that transaction and rolling any of their upside into that new transaction to show their conviction in the opportunity. And maybe that's an obvious one, but it's not necessarily the case in every situation. The other continuation opportunity you see, right, looks more like a traditional secondary where you have multiple assets. So you're, in theory, de-risking the opportunity that you're underwriting at the end of the day. And in that situation, yeah, maybe we put on our secondary hat. Maybe we're even putting on our fund hat. I think Jeff's comment on IRRs was kind of spot on. And I think secondary investors and co-investors and fund investors all kind of think about that equation a little bit different. I think the easiest extrapolation would be, the secondary guys tend to be more IRR and short duration focused, and co-invest individuals are probably more MOIC focused. And, yes, that duration might be shorter than a fund commitment, but you're wearing a couple different hats in that situation. And so then there's another overlying kind of, dynamic of who is funding these continuation opportunities, right? And I think one of the dynamics we've seen play out is there's a lot of capital that's been raised everywhere, as I referred to before in the dry powder comment, but no more so than secondary land, right? There's no shortage of kind of billion-dollar, multi-billion-dollar plus secondary funds that are out there, and we're seeing those secondary guys come down in and chase a lot of these single asset continuation opportunities, which I think is fine, right? And if you're doing enough of them within the construct of a diversified portfolio, you're probably kind of getting what you're looking for as a secondary investor at the end of the day. But if you're considering them on just a one-off basis, right, that's a much different kind of diversification parameter than you might get in a secondary transaction. So for us, where we tend to focus more often than not is the single asset opportunities where the GP conviction or role kind of aligns with how we think about the world. And then typically it's with a GP that we already know well. Now that's just us, right? There's secondary funds that have different kind of, different investment criteria, but that's at least how we've been thinking about that opportunity set to date.
I'd like to point out just the technical problem that everyone will face with these measurements, that basically IRR is an attempt to get a point estimate of a two-dimensional thing. The two dimensions are MOIC and time. And similar to standard deviation, which actually is a point estimate of a two-dimensional frequency distribution with a very specific shape. And if your phenomenon doesn't fit these things pretty well, for example, the IRR, that you're actually able to reinvest the money at the same rate that you were earning it, these things don't mean a whole lot. So we focus mostly on MOIC. I'm working on a graphic solution maybe to this problem, but if you look at MOIC and what the time frame was graphically, how it grew, you'll have a better feel for what was going on than if you look at a summary statistic that actually loses information. For those technically inclined, you can read Shannon's theory of information from Bell Labs as to why, but you actually lose information. And the other aspect of it is that we look at the dispersion of returns, and this is related to this Jensen inequality problem, and we look at it in a non-parametric way, meaning we just look at the dispersion, not try to force it into a standard deviation point estimate, because you'll lose too much information. And those are the two criteria to understand at least what has gone on.
Yeah, I understand, but having worked at institutions most of my career, usually you need to use a metrics to compare the asset class with all the other asset classes when you're determining the allocations for the program for the year. So, most other asset classes, fixed income, real estate, senior debt, whatever, they don't usually use MOIC. So when you work for a big, I understand you're working for yourself, so you can use whatever metric you like. But when you're working at a big institution, IRR has to be part of it. So I think it is a big dilemma now with the credit lines. How do you assess performance and determine asset allocation? But I guess I'm just curious on the continuation fund theme also, though, how does, and maybe either of you have an opinion on this, or Jake as well, how does the average limited partner who usually invests just in funds and doesn't have the direct deal skill set, and now they're getting, from what I understand, like one continuation fund evaluation a week, and they have to analyze the underlying deals and make a determination either on an individual deal or a whole portfolio. How do they simply process everything and do it when they don't have that skill set?
I mean, listen, it's a good question. I certainly appreciate where it's coming from. You know, we're fortunate that we've got a team of 12 that's focused exclusively on this universe, and you know, half of my senior partners come from the direct GP side of the world, and so we can kind of quickly put on that hat and do that direct deal underwriting. But yes, I appreciate it. If you're a small family office with only one or two investors, or even a small endowment, or you know, a single high net worth, it's getting complicated, right? The private equity ecosystem is not just making fund commitments anymore, right? And there's been this gradual kind of evolution. If we look at like the last 2 decades of private equity investing, from traditional fund investing, then secondaries and kind of co-invest found their way into the ecosystem. Now we've got continuation opportunities. We've got the rise of the independent sponsor and the unfunded sponsor. I think like any asset class, there's just naturally an evolution. If your hat is just, you know, we're just doing fund investing, it's going to become very difficult for you to kind of do that underwriting of these continuation opportunities. I can certainly appreciate that, right? If you're just not set up to kind of, you know, to kind of roll into these situations or do that underwriting, right? You've got 2 scenarios most likely, right? You either defer to the GP. What are you guys doing? And in said GP we trust, or to a little bit of maybe what Jeff was alluding to before, if you have other places to allocate that capital, right? And you want to take bird in hand, and do other things with those portfolios, those are the things you have to strategically think about. But yes, doing single asset deal underwriting is a very different due diligence process than finding a good manager that you're going to partner with for 10 to 15 years.
You can really apply 2 simple questions. One, if I saw this deal de novo, would I do it? Not as a good deal or a bad deal, just would I do that if it just came in unsolicited? And number 2 is, how much do I trust the GP?
But I think it's also like, I think you have 2 ways to co-invest, right? You have co-invest from an unsolicited fundless sponsor. You've never seen the asset before. And then you have these continuation vehicles where you've seen the asset, right? Like you've owned the asset through a diversified pool of assets, but you've heard updates on it. If you're going to do co-investment, sometimes it's a more comfortable way to limp into it. I think what it does though is it actually puts a lot more onus on the GP to make sure, look, if you want to have a seamless continuation vehicle with a single asset, you better hope your content and transparency over the life of that fund and how you reported on that particular position or things that you updated your LPs about on that position are good. That only makes your job easier, right? But I think you're seeing a lot more demand from LPs to say, hey, what's going on here? I need more than just a statement each quarter.
I think Jeff's second point though is well, both points are spot on, but the GP is super important in this one, right? So if you have a GP that is in your roster of active investors that you're inclined to do deals with, that is a great dynamic. It is an even better dynamic if that GP is essentially doubling down. That math may not be right, but essentially doubling down on an asset that they could sell to somebody else in mid-market private equity and crystallize that carry check. But they're saying, no, you know what I'm going to do? I'm going to roll any economics that we've got in that deal today into this new transaction because I do think there's another 2 or 3 turns here. We think that dynamic is really interesting. It's not always perfect, but we think that dynamic is pretty darn interesting.
Jake, in terms of due diligence on this theme, how has your due diligence changed and the GP process overall in today's market where things are moving so quickly and you can't meet people in person for maybe you can, but some people won't meet in person for diligence, and a lot of people weren't flying for a while. How do you conduct due diligence in today's market?
Yeah, I would say the short answer is not a whole lot has changed from what we require in order to get comfortable with the asset, right? I mean, we're still a very value-oriented shop where we need full access to historical financials. We need to run the 3-case model underwriting that we do, et cetera, et cetera. Oftentimes with investments we make that are, toward the upper end of our position sizing, we'll do third-party management assessments. So a call or a Zoom that's done with a third party, with the management team that produces, an extensive report on different attributes we look for. The one thing that I think has changed, and you hit the nail on the head, Cheryl, is just the pace. So because there's so much noise and a new GP pops up every other Monday, right? Entrepreneurs are more inundated than ever with, hey, we'd like to get involved. We'd like to get involved. So what we've put a lot more emphasis on is not only tracking companies or investment opportunities within sectors we like, but tracking the engagement with those potential management teams. So when did we last touch place? What was the outcome of that engagement? When should we be back in touch, and how should we be back in touch? And doing it on sort of a forensic basis, because we're pretty confident that the world of haphazardly following up or hope you remember is just over, and that the requirement around extreme precision and how you're engaging in the cadence of your engagement is extremely important now with, such a noisy and sort of cluttered market.
Yeah, I mean, time management is getting harder and harder. The one thing is, I see the Q&A has 2 questions in it. Am I supposed to ask them, Jeff? I mean, Kevin?
Thank you, Cheryl. And that's why I was just popping on here for you. And this might be a good way to wrap things up. We've only got a couple minutes left. So you can tie this into any of your comments. And frankly, I'll take this question as a criticism for this kind of forum. All of you have so much you could say about any one of these topics. And one thing that Jeffrey said that was interesting is that, there are a lot of things where there's a simple answer, but it's wrong. And the question on the box was, Jeff, if you could give an example of that, investment related or otherwise. And,
Sure.
If any of you have any simple ways that you phrase, any of your perspectives on this market, this would be the time to get it in, and then we'll be moving on. Thanks.
So I'll give one from medicine or 2. When I was a teenager and had acne, it was the common belief in the medical community that because pimples had pus in them, that the trick was to dry out the skin. They did this using UV treatment, which led to an annuity for all dermatologists for decades to come, because it actually creates skin cancer. And the correct theory was that acne was caused by bacteria. Similarly, the doctor's name I can't remember, who theorized that ulcers were due to H. pylori, were shunned at gastroenterology conferences because that wasn't the current theory. And it turned out that, in fact, drinking milk was not exactly helpful. It had more bacteria, and for people who are lactose intolerant. Another was, of course, Ptolemy versus Copernicus. The simple answer, if you simply looked out your window, or if you didn't have a window, just looked up, it would be clear that the sun was revolving around the earth, despite the fact Greeks had already figured out that it was not true, that actually the earth must have been revolving around the sun. An idea resisted for literally hundreds of years, especially by leading religious authorities. In the investment world, the simple theory, which was useful for a moment, was actually University of Chicago, efficient markets, and the Markowitz Theorems. The Markowitz Theorems, there's 2. One is that the expected return is the weighted average of the component returns. And the second theorem, the second part of the theorem, these are theorems, not theories, they are mathematically true if the assumptions are true, which he knew they were not true. It was highly stylized. So the simple answer was that you can create free lunch diversification by having things that are lower correlated. And the CAPM theory, which these are all associated theories, was similar in that it led you to believe with the efficient market hypothesis that the optimal investment portfolio was somehow the cap-weighted version. All these were highly stylized versions of the world and of the world of investing, the assumptions of which, if you look at any standard textbook, it's either 7 to 11 for CAPM. Every one of the underlying assumptions is empirically false. There are not a whole lot of theories in science where all the underlying assumptions are known to be empirically false and the theory is still true. But it's a simple stylized way to begin to think about it that unfortunately made no progress after about 1960.
Well, off the top of your head, the fact that you've remembered all those statistics, that in and of itself is very impressive. So I think we're about out of time. I know there were a few other questions, but we can't get to them right now. Thank you, everyone. Thank you, Kevin, for the opportunity. Thank you, everyone, for your contribution. And I'll turn it now to Kevin.
Thank you very much, Cheryl. And thank you for all of you writing in questions and so on. We can't get to everything, but we will be moving on now to the panel discussion on changes and opportunities in private credit. And I'll be moderating this discussion and directing some questions to Brett Hickey, founder and CEO of Star Mountain, and Scott Barfield, managing director at Callodine Strategic Credit. Brett, starting with you, would you mind introducing yourself and your role, since you wear a lot of hats throughout the development of Star Mountain, and please remember to share something for which you are thankful.
Sure. Thanks, Kevin. Hope everybody's doing well, and nice to see some old faces again that I haven't seen in a while here. So thanks for putting this all together, Kevin. I'm the founder and CEO of Star Mountain Capital. We're a specialized private investment firm focused exclusively on investing in the US and Canadian lower middle markets. We have private credit, private equity, and secondary fund investing strategies with a multitude of different structures to suit different type of desires for investors within that. This year, we anticipate investing in approximately 40 private businesses, deploying just over 700 million of capital, which I think makes us either the largest or one of the largest investors in what we classify the lower middle market in the US. We have people local in 20 cities across the country, and we are a 100% employee-owned firm. What I'm thankful for, aside from having a great business that's probably my first child in that sense. I've been investing in the lower middle market for 20 years, started Star Mountain 12 years ago, is my two other children. And they're 5 and 3, and they've been doing great with school, as any parent, I guess, hopes for, and was tough with COVID initially, but things have been going great. So I'm extremely appreciative for all the teachers and other people that have made this possible.
Sure. Well, I'm sure that's been a challenge, but you're no stranger to challenges. And, one thing that I think I've gotten from you in conversation over the years is that you feel private credit is a great way to protect against some of the, I think it was unknowability that Jeffrey was referring to, and his expounding on Jensen's inequality. And what I took from that was, don't lose money. That's the first and second rule of investing, from the way I understand it. And in private credit in general, you cover a broad range of these areas. And it just appears to me that, referring again to the last panel, but Sheryl was making comments about how private markets fluctuations have been more moderated, and private markets in general have been very durable. And I would say private credit takes that even to a further degree. There's a little less volatility and so on, and you can diversify and so on. So I just wanted to tie in a couple of those ideas from the last panel, because I think it's all very related. And that brings us to Scott Barfield. Scott, please introduce yourself and something for which you're thankful.
Yeah, absolutely. Thanks, Kevin, and great discussion on the private equity side. Really enjoyed it. Although I will say that some of Jeffrey's comments probably went over my head a little bit there. But no, I am Scott Barfield. I'm with Callodine Capital. We are a current yield-focused investment manager based out of Boston. Although I am actually in Atlanta. So, the way I look at our business, we have a public side and a private side, the public side being our hedge fund activities. And then on the private side, we have a private credit platform that would include a senior debt group, a mezzanine group, and a BDC. And specifically with myself, I focus on the Mezz group and the BDC, where we're targeting companies that are in the lower middle market that generally are below 100 million of revenue, and more kind of specifically in that 3 to 8 or 3 to 10 million EBITDA range. As far as something I'm thankful for, I'm going to go with the personal route. In the fall, we just transitioned our youngest son over to college. And I think it was successful because he hasn't come back. And so my wife and I are now empty nesters. And so that's something that I'm grateful for. Now, certainly they can come and visit, but at a certain point, it's just tough to live with 18 and 20-year-olds.
Right. That's a helpful perspective. So congratulations on getting some sanity there. Look, sticking with you, Scott, given that you've made a transition into your current firm, and of course, you've been in the strategy and you've been consistent in your investments over a longer period for sure, but coming under the Caladyne umbrella and so on, and your role shifting and so on, as COVID was hitting as a reality, what's been the biggest impact of COVID on your operation, and has it changed your perspective on private markets in general?
Yeah, no, good question. So yeah, I came over to Caladyne about 2 years ago. I've been in the lower middle market private credit world for 20 plus years with our own funds, but then we merged our fund into Caladyne, and it was right as COVID was hitting. And so I think there's probably been a couple really big disruptions overall to our business. One is, and you look at our business, we fundraise, we invest capital, and we monitor the capital. And obviously, when COVID hit, we transitioned almost 100% to managing the portfolio and managing the investments. So, really the fundraising side of things, the investing of the capital came to a stop, almost 100%. And so, we were growing very rapidly. Then COVID hit. We put on hold some of our fundraising, some of our other activities. We were looking at doing some additional acquisitions within Caladyne that came to a stop. So I think, really that was from our personal perspective within the fund, that was the biggest impact of COVID. And, and once you stop those activities, it takes, you have to build back some momentum to get them going again. So I would say, we're 12 to 15 months, past when kind of COVID really hit. And we're just now beginning to reinitiate some of those activities. So getting back to the growth area of what we do. I'd say from an operational perspective, one of the other things, and Jeffrey hit on this as well, we're a lower middle market focused investor. And so, we're very focused on companies that are 3 to 8 million EBITDA, and you really have to be active managers within that sector. And so, we're very due diligence intensive. We like to have 2 or 3 or 4 meetings with management face-to-face before we commit to a transaction. We like to have face-to-face board meetings, that kind of thing. And in the COVID environment, some of that just wasn't, it just wasn't possible. I mean, I think, we did make the determination that we weren't going to invest capital without having at least one face-to-face meeting with management. But then you're trying to actively manage a portfolio without being face-to-face was very difficult. I think, the second part of your question, how's that impacted my views on private credit? I think right now it really hasn't. It was kind of confirmatory from our perspective that going through shut down with COVID, and we had, a couple portfolio companies that were completely shut down for a period of time, and certainly all of them were impacted, but was really confirmatory, I think, of our strategy, that these companies were able to survive during that period and then come back very strong. Although I would say right now we're probably, seeing some headwinds that are as disruptive as last summer, with the things that we're seeing coming out of COVID, which, the raw material price increases, supply constraints, labor issues. And so coming out of that, we'll see, that will certainly change our strategy somewhat, primarily probably in some of the industries that we'll look at.
Yeah, it's interesting that some of these long haul effects that I referred to in the title, and I don't want to dwell too much on this, but maybe it takes us out of the COVID conversation. Some of the factors and the changes that we're seeing now can be perhaps more impactful. And with that, Brett, your firm was in a very different situation. You've been growing and evolving for a decade and had recently expanded office space in New York. I mean, a lot of things were happening when COVID hit. So what's been the impact of COVID on you and your view on the markets?
It's a great question, Kevin. And yes, I probably wish my office rent in New York City was a little bit lower than it is, but thankfully the business has grown well. And so just like with our portfolio companies, revenue can solve a lot of problems that way. So we feel quite blessed. Your earlier question around feeling thankful. For Star Mountain, don't ask me to time the markets for you or bet on stock prices, because as you know, with my wife, Kevin, I convinced her at the end of 2016 that it was probably a good time not to be in the markets. And you can all see how fundamentally inaccurate I've been that way. And so I think that's a good, lesson as we think about credit. You mentioned capital protection. It's a key fundamental pillar. So with Star Mountain, we, take that very seriously, as all credit investors do. And I think being a 100% employee-owned firm and having a very substantial amount of our own personal capital invested changes the view in how we operate a little bit that way. So we've avoided end industry sectors that are challenging in a more normalized, and I don't know what a normalized recession really is, because frankly, every single one is different, right? 01 was different than 08. This little pandemic blip has been really different than everything. And, those are the three recessions I've invested through so far. And we did take a view that we were, long in the innings 5 years ago. And so I think, as Cheryl Schwartz mentioned earlier, there are a lot of different challenges out there. So for us, that's been partially fortuitous as far as structure, partially lucky that the industries that we've focused on building very deep core competencies on within our operating team and our operating partners, where in total we have 80 people. We've got very deep expertise in a lot of sectors. In some sectors, we have zero in. Don't touch energy. Don't touch oil, real estate. So the sectors that we're deep in, they continue to have positive long-term trends. And if you can keep your fundamental focus on low leverage, what we have found over time is that low leverage lets you work through macro shocks and idiosyncratic risks generally. And as Scott mentioned, taking a very active hands-on approach to working, with your companies and being a strategic partner to them. And so for us, we did take a pause for about 3 months during COVID, but then we were full throttle back on, and it's been phenomenal for us. We're lucky in a sense how we designed our firm, because we have people local in 20 cities across the country. So I didn't get on an airplane for over a year. I don't know exactly how long, but we had people that could drive to in-person meetings. To Scott's point, we also believe that same thing, that there is value to in-person. And so having people local, having deep industry expertise to really take a view, we think time will tell, will have been really a strong alpha generating opportunity. And as the population ages for players like Scott's firm and ours at Star Mountain, when you focus on an end of the market that has an aging demographic, that's great, because more people are willing to transact. there was conversations earlier about capital flows, I'll call it, and what's going on in the larger markets today. And I think it's very straightforward. You can't fight the laws of gravity. You can't fight the laws of supply demand, right? I live in Greenwich. Take the same house here as you do in some other city, same bricks, same size plot, same wood, and the prices can be dramatically different. So supply demand, you can't really get away from that. And I think investors often forget about that because they hope in the larger markets where returns are lower, we're all trained to think lower return equals lower risk. When in fact, I think what Scott and Star Mountain, what we would all argue from our data-driven approach is that there are many other factors, not just what you get paid. And in today's market, people call the momentum-based market. Another way for thinking of momentum means there aren't fundamentals, right? What's it worth? It's worth what somebody will pay for it. And I think cryptocurrencies or art or things of that nature are probably your best example, and what we take a view of at Star Mountain is timing the markets is very difficult. But fundamentally, one of the things that's positive about the lower middle market is the aging demographic and the valuation arbitrage. If you can grow your business from around 10 million of EBITDA to around 20, it depends on the business, lots of variables, but in general, you can substantially increase your valuation multiple because the middle market where you can write bigger checks, there are more investment banks involved, more private equity firms and so forth, just allows for much more efficiency, a lot more capital inflows through CLOs and other, and therefore much higher valuations and prices. So as I'm sure Scott sees, as we do at Star Mountain, there are a lot of business owners that are sort of like Scott that are now an empty nester, which we think is an awesome time to back people where they have experience. And sorry to use an example there, Scott, but where people are business owners that have experience, that have energy, and now their kids are out of the house. And so they've got time once again. What a great time as an apex to back talent of lower middle market companies, where they say, let's hit the throttle hard for another 3-4 years, grow to the next level, and then sell. And so for us, those dynamics have just made this market opportunity pretty exciting and compelling for us, at least for the time being and the short term ahead as we see it.
Right. Well, that's encouraging, and I'm not surprised that both of you have not been knocked off of your general principles around this business. But that speaks to the general mentality. Let's dig in for a second on some specifics. And in the short term, after COVID hit, what short-term changes or actions did you need to take, stabilizing portfolio companies or what have you? And I don't want you to frame this in case of, an historical conversation about what happened a year and a half ago, but more as an illustration of how you manage loss ratios and those advantages in the lower mid market that you're talking about. Brett, Scott, actually, why don't we just start with you, Brett, since we have you, and just quick comments on that. Any examples?
Sorry, I was just typing a response there, Jeff, in how markets have changed for us.
Yeah, no, I stretched that out, pardon me, but it essentially in terms of short-term actions that you needed to take after COVID, how did you stabilize portfolio companies or make any other changes as an illustration of your strategy?
Yeah, so one of the things that we've done at Star Mountain is invest very aggressively in technology and systems and talent, and have built a lot of custom tech, because what we found is that actually this is for big and small companies, is that problems usually get worse before they get better. And so therefore you want to be able to identify the problem quickly and deal with it quickly. So for us, we've developed a lot of proprietary infrastructure that allows us to capture data on underlying portfolio companies in a rapid manner. And then we typically have a lot of covenants and abilities to do something about that. And we overlay that within the operational capabilities where we have full-time control buyout partners in-house and former C-level executives and business experts, so that we're not just looking at financial statements and saying the obvious. You need more revenue and less expenses. Okay, great. Thank you very much for your help. That was really insightful, a business owner might say. Or you just say, cut expenses. Well, where? How to do it? How do you make sure you make decisions so that you're not making something quick for the short term that might have a really negative long-term impact? And so I think that's where the active approach we take with that expertise and the data really helped us assist our portfolio companies in making the best decisions possible, right? It's not like math where there's a definitive right or wrong answer, but you're taking probability weighted decisions. And so every single business was very different in how we looked at them and how you're looking to look for new ways of revenue, retain revenue you have, look for ways of cutting costs. Some portfolio companies we had double revenue, like our telehealth company, so that's a different dynamic, right? And fast growth has its own challenges, right? And how do you make sure you're growing really quickly, properly, and safely? So every single situation, Kevin, was really different, but it's that hands-on active approach. And in our view as Star Mountain, is having a very senior team working with these business owners that have been through multiple cycles. So you're really thinking short, medium, and long term.
Yeah, thank you. And Scott, any particular actions you took that showed how you can handle tough situations?
No. Certainly echo what Brett said. All of that obviously is very important, and we're very, as I mentioned, actively focused in managing our portfolio companies. I'd say during COVID last summer, those were different challenges than we're seeing today. They're impacting, last summer we had different portfolio companies that were impacted differently than today, with the disruptions coming out of COVID and restarting the economy. I would say during COVID, kind of the June, July timeframe last summer, we didn't know how long some of these shut down. We had some portfolio companies that literally were shut down. Fortunately, we only had a couple out of the portfolio, but we did not know how long it was going to last. Some of the specific things and actions we took last summer were, obviously becoming more active in monitoring the companies. In a lot of situations, we moved to weekly calls with management. And I'd say probably half our portfolio went to that, where we were interacting with them on a weekly basis. And then specifically, some of the things that we did, was to immediately defer interest, particularly with the companies that were shut down for a period of time. And anywhere from 4 months to 6 months, I think, was probably the longest time period where we cut off our interest in order to preserve cash. Obviously going into that situation, the way we view it is liquidity is king, or cash is king in those situations. So you try to pull and collect as much cash as you possibly can. We also then began to work with senior lenders, and I would say that the senior lending world was very accommodating in helping with, covenant breaches, even deferring interest on the senior side in a lot of cases with our portfolio. I would say that the senior lending market is still very accommodating even today, and it would be a good question to kind of theorize as to when that starts to clamp down a little bit if some of these companies continue to underperform. And then the other thing was addressing and discussing with our companies capital contingency plans beyond that, because the deferral of the interest, the dealing with the senior lenders is more of a temporary solution, obviously, for a period of time. But if it were to extend for 6-12 months, there would be there probably need to be some fresh capital brought into the companies, or some harder decisions to be made about the company. Interestingly, that was during COVID. Interestingly, today, where we're dealing with some disruptions from restarting the economy with raw material price increases, supply constraints, and the labor issues, different set of problems today. We're looking more at, every single one of our companies, I think, has been increasing pricing, probably more than once this year. So that's been a big issue. And then there's probably been some tweaking and cost cutting around the edges. And so probably half our portfolio is right now strategically looking at where they can, maybe cut some areas here, maybe grow some areas there, but in the net, eliminating some costs where they can.
Yeah, thank you. And some of those actions and, the relationships and so on that go into what you're talking about are particularly important in the lower mid-market. And I'd just like to address that because I think some of the people here in the audience, even if they're familiar with private credit, may not be as familiar with the dynamics within the lower mid-market, in terms of loss ratios, essentially risk, and the debt to earnings ratios and so on that go into that. So starting with you, Scott, what are a few specifics that make the lower mid-market appealing?
Yeah, I think there's probably 3 or 4 that jump into my head at a high level. I think, we're based in that 3 to 8 million EBITDA range for a very specific reason. Brett mentioned some of the inefficiencies in that market, but also it's less competitive in that 3 to 8 EBITDA market. We want to stay away from a broad BDC market where there's a lot more capital. And so that's one of the big reasons that we find the lower middle market so attractive. And then, the inefficiency within that market, it's a very large market as far as the number of companies, probably a couple 100,000 companies that are in that space, probably account for 60% of the employment, in the US. So it's a very large market, but just doesn't have the sophistication with investment bankers, within that market that are working with a lot of these companies. And so you can get some of that positive, pricing momentum and structuring within the market. And then, I think, one of the other big things is that these are just, every single one of our deals is a very customized, privately negotiated transaction where we can structure things and price the deal according to what we think the risk is. And so I think that's a very big mitigant overall to some of the risk is the way that we structure and price the deals. And then that, kind of finally, that would go into the whole covenant packages that we put together. And, the covenant and the legal structuring that we do, within our transactions really helps us mitigate that risk overall. You kind of look at it and say, well, look, it's these are smaller companies, aren't they riskier? And I'd say, look, we kind of level the playing field by the things I just mentioned, the way that we structure them, the way that we can price them, the covenants, and where the entry price point into some of these companies because of that inefficient market.
Sure. I don't want to dwell on that, but Brett, I've heard you talk about some of those points. Anything to add?
Yes, so if you take I of course can't share our experience specifically on a panel like this, but happy to follow up with anybody and share specifics as to what we have been able to achieve that way. But taking some third-party data, and this relates to supply-demand dynamics once again. Both S&P and Moody's did very long-term studies, and I think that's important long-term because you need to kind of flush out any market anomalies. And so in the case of both S&P and Moody's, they were each around 25 years. And what S&P found is that the larger loans systematically had a 300% higher default rate. And so you think, and we're conditioned to think that if something costs more, it might be better. If returns are lower, you hope it's lower risk. But people forget about massive capital inflows and how that changes the dynamics of both risk and reward. And then investors will often say, well, why would people even invest in that market? And the answer is quite simple. When you have massive volumes of capital you need to put to work, you can't do it in strategies like Star Mountains and Scott's, right? We take, as Scott mentioned, these are labor intensive, bespoke transactions, often taking months to negotiate to find the businesses. If you're financing an acquisition, they've got to get the seller to agree to sell, get all that done, the combined business analysis. It's a lot of work. That's what keeps a lot of competitors out. Pretty straightforward, whether it's banks or large asset managers. And ultimately, as a result of the market, as Scott mentioned, being around 50% of US GDP, a couple 100,000 private businesses, you're not competing aggressively with the larger financial institutions. That creates, really good supply-demand dynamics. The challenge is, of course, how do you find them? But what we have seen from a third-party data perspective is that, in short, what we believe is that it is possible to make a lower leveraged loan to a smaller company, and that may in fact even be safer than a higher levered loan to a larger company. And because of the market inefficiencies, and if you can overlay some value-added capabilities like we do at Star Mountain, that perhaps gives you the opportunity to create some incremental premium return.
Yeah, so it sounds like it comes down to whether or not you have the process and the people to do the work. There's a lot of legwork to be done here. And as you're out there hunting, what types of opportunities are most interesting to you as the economy gains momentum here? And I'm talking, in your case with Star Mountain, Brett, it's you have a range of different strategies. So, but for you, Scott, you're focused more on mezzanine, so it might be more around what particular sectors or deal profiles, whether or not you're working with companies that are owned by private equity. What are some of those factors that are interesting? Brett, I guess you could start.
Okay, sure. I guess for us, we really look at end sectors and maybe remind people that every big company started as a small company. So if you want to back innovation and you think there's growth in technology and sectors that we see, there are some business models that didn't even really exist 10 years ago that today are dominant, critical business models in society. For example, YouTube, not overly relevant a decade ago, owned by Google, one of the biggest and most impactful advertising channels now in the world, where people can do very targeted advertising different ways, but hugely complex user-generated content, right? Developed and paid content, lots of challenges and opportunities, and how do you get in front of consumers for different products and services? So that's an example of a portfolio company we have in that space and helping them really go through very rapid growth. And so we love that, right? It's a lot easier to double the size of a smaller business than a bigger business. So that's just systematically, a positive thing. And when we think about technology and how quickly it is revolutionizing different industries, that means that there are, in many cases, new business models being created that didn't exist before, which can be really exciting businesses in the future, right? Telehealth, we had a portfolio company or have, pre-pandemic even, that, we all knew was a good long-term trend. Of course, the pandemic has accelerated, not just the desire for that, but in fact, the need for that. And I think if you take a step back and you ask yourself, well, how much innovation is going on across, lots of industries and maybe even all industries, I think that's pretty exciting, right? If you have the ability to find these businesses and really have some expertise within industry sectors and have the operational capability to work with these smaller companies and the willingness to do it, right? Because it is really labor intensive. And I always say to people, there's no free lunch in life. You're either getting paid for risk or trying to time the markets or something. In my simple way of life, growing up in Canada and speed skating and working on the oil drilling rigs, I've never thought I'm smarter than other people, but I'm not afraid to work hard. And that's really true to the DNA at Star Mountain. It's a very labor intensive model, and we'd rather get paid for labor than what our view is of perceived risk. So that's what excites us just generally in an economy that is evolving due to technology quite rapidly. And maybe one last thing, just as a reference point, if you think about technology, really big businesses used to have a massive advantage, right? If you wanted tech and you wanted a big data warehouse, that was expensive, right? We've invested in server farms as of before. It took you a lot of money to do that. So if you were a smaller company, you really didn't have the budget to implement technology. Well, nowadays, anybody here can plug into the Amazon cloud, right? And that's one of the most comprehensive data sites that you could possibly ever build, right? So now a lot of these technologies that used to be big barriers to entry that only bigger businesses could afford, now you have smaller companies that can really say, hey, I don't need to worry about these legacy issues. I can just build modern, optimizing all the tools that are now at my disposal today. And that's something very different that 5, certainly 10, even 5 years ago was really not the case. And so I think that advantages smaller companies that are more nimble and can be more strategic and not have to worry about legacy issues as a thematic tailwind.
Yeah, that's interesting as a broader view on the different opportunities and the deflationary aspects of tech in particular. Scott, what's your
No, I absolutely agree with what Brett just said. We're looking at some of the same things. You know, I think if you look at what we like to do is historically we've liked companies that are more old line and business service companies that are trading. You know, you would look at these and say, hey, they're 5 to 7 times enterprise value multiple companies. And so, you know, there's not a lot of volatility in that multiple over time. So we're not looking at, you know, companies that can trade at 10 times or 12 times. And, you know, some year they may trade at 8 times. So, you know, we very much stay within that 5 to 7 enterprise value multiple. What we've seen and what we've got very interested in as of late are sectors where you're taking some of those, what we kind of view as old line economy companies, and there's some aspect to the technology that they're using that is somehow beneficial overall to what they're doing. And, you know, by way of an example, we invested this year in a company that sells perfume and body care products, you know, e-commerce company. So it's all online. Being online is not necessarily any more, you know, a technology-driven aspect to what they do, but they inventory all of their products, and they have developed a proprietary warehouse management system that increased their ability to ship product. So they went from being able to ship 2,500 units a day to being able to ship 5,000 products a day, you know, just by implementing this technology component to their business, this warehouse management system. So those are the kind of things that we love. And when you're talking about, this is a 40 million revenue company, you know, they have now the capacity to grow to 75, 80 million of revenue, you know, just from being able to leverage that technology. So those are the kind of plays that we see today that we really love. You know, a couple other comments maybe that are, you know, kind of widespread within what we're doing these days within our world. I would say certainly, you know, we used to see 50% of our portfolio that was private equity, 50% that was more family owned. Over the past couple of years, we've almost exclusively done private equity deals. And so we certainly over the last 12 months or 15 months have seen much less kind of family oriented non-institutional investment opportunities. And I think that's probably just characteristic of the amount of capital that's within the private equity world. And then we've gotten very much into the independent sponsor world, which has always been a piece of what we've done. But, you know, I think what you've seen is a growth within independent sponsors. And, you know, 5 years ago, we would see an independent sponsor that, you know, some investment bankers who just quit their job and is doing their first deal. You know, nowadays we're seeing independent sponsors that have significant experience, have done, you know, 5 to 10 deals as an independent sponsor, you know, have a pool of resources internally, you know, 4 or 5 people, analysts, associates, you know, internally. And so we've really seen that market come along quite a bit over the past few years.
Yeah, thanks. And as we wrap up here, we always run out of time. There's so much we could talk about. And both of you seem to agree on a lot of things. You've even said so. And there's room for the two of you to work together in various ways. But there's also a distinction here between a larger, more diversified shop like Star Mountain and more of, I guess, an emerging manager in your team, Scott Bar. I've talked about in past events that there's momentum on fundraising with larger firms as LPs relied on existing relationships, especially through COVID. And investors claim to like emerging managers with fire in their belly. So I need to hear the pitch from each of you as quick as you can make it. Which one's better? Scott, I'm starting with you.
Oh my gosh. Well, I wish you'd have chosen Brett to go first, actually. But this is a hard question, right? I mean, certainly we haven't necessarily seen the other side of it. We are viewed more as an emerging manager. We often feel like we're selling off of intangibles, more so than, maybe what Brett is selling off of, meaning that, we don't have our third fund. We're not on our third or fourth fund. We don't have an extensive list of exited transactions or track record that we can necessarily point to. But look, I think the thing that, so in that sense, we feel like it is always probably a little bit more difficult to fundraise as an emerging manager. But what has really helped us, I think, over the past couple of years is that just the whole sector of private credit, mezzanine has become much more widespread, has become much more of a household name, if you will. And in fact, if you look at our lead family office investor that invested with our first fund and now is investing with our second fund, they identified mezz as an opportunity that they wanted to get into, and they came to us. And so, I thought that was a really interesting dynamic. It is a lot easier today to go into an LP and pitch private credit because it's something that they do know about, it's something that they're interested in, and a lot of times they already know it's something that they're looking for.
Yeah, thanks, Brett. You wanted to grow, you grew. Why is that good?
Yeah, look, I always start with the end in mind. So what are we looking to build for investors and why they value that? And wholeheartedly agree with it's tough being in Scott's position where you're selling the intangibles. I used to call it selling the dream. I sure love selling the facts and the track record that way now. Makes life a lot easier. So I've been in both situations, and it's nicer to be able to sell the track record. That's just it gets you through a lot of doors a lot faster and easier because you can really talk about, well, different aspects. Is this risky or not? Well, let's look at how you measure risk, loss rates or defaults or leverage ratios, covenants. You can go through a lot of facts and a lot of case studies. Having closed nearly 150 investments at Star Mountain now, it gives a lot, and our team has collectively closed over 500 investments across our careers. So that's one. Two is you think about building a portfolio, and I think the pandemic is a great case study for why this is important. Diversification. When you're building a credit portfolio, we like to keep diversity. So having a bigger team, having, approximately 50 full-time people and then 30 additional advisors and operating partners allows us to build a bigger, more diverse portfolio. It allows me to afford to have, deeper workout teams, more industry specialists, as we talk about industries, just more resources, more knowledge, and the ability to build a what we believe is a more defensive, bigger and more diversified portfolio that way. And then to the fire in the belly, I think that is critical, though. You want to back people that are driven, focused, and aligned. And the approach that I took in building Star Mountain, which was not easy getting off the ground, as you know, Kevin, but we are still 100% employee owned. And I give carried interest to 100% of our employees. There actually aren't many firms that can say that. And so the alignment that we have with our own capital invested and then with the share profits is really the North Star of Star Mountain, is that shareholder and team alignment. And I think that has assisted us in driving the results we have generated historically. And we believe will be a key aspect that hopefully has us continue to deliver similar results into the future.
Well, I hope it does. And whether you're selling the dream or living the dream, we've got two good options here. And I really appreciate all of your comments. We will need to wrap this up. I appreciate the people that stayed on the box here after our closing time. And I especially appreciate it since we won't be back for a little while. Backing off the schedule here. Our next webinar will be March 2nd. I'd like to thank all of our speakers from the private equity group as well, for those of you that are still with us. And as we trip into the holiday season that's embellished and extended in ways that only Americans can imagine, I'd like to wish all of you a happy Hallow Thanksmas. Did I miss anything there? I'm sure I'll get some kind of criticism, but hey, you get the idea. Enjoy, please. And hopefully we'll be coming back with live dinners. We heard a couple people talk about the importance of getting together in person. You can't do all your diligence over Zoom. So put your pants on and get out there and meet people. And LP GP events that I used to have will be back eventually. That's how a lot of you know me. And I want to say that we'll have a couple of topical dinners in the spring, but I've had to delay on those comments in the past. So I'll just be announcing those details as we get to a critical mass of people in their New York offices in particular, but eventually I'll try to get out there and do some of these dinners as I did in the past in other cities, Chicago, LA, Miami, what have you. So we'll be announcing more details on live private markets insider summits shortly. And we're still open to speakers and other ideas for topics as we plan for those dates. So as a final reminder, Private Markets Insider is a platform for identifying investors, funds, and deals through relevant content in our community. So feel free to reach out and chat about what you're seeing, what you'd like to see. And I may follow up with some of you to chat soon about deals and funds that may fit your interests. Meanwhile, I sincerely hope you enjoy your holidays with friends and family as things open up. So goodbye, everyone.